I cover energy here at CNBC, and here's what you need to know about Iran's role in the global oil markets. Iran pumps around 3.4 million barrels per day. By comparison, Saudi Arabia almost triples that at 9.5 million barrels, and the U.S. pumps even more, about 13.5 million barrels per day. On top of that, existing sanctions due to disputes around Iran's nuclear program means that Iran's exports can't be sold on the open market.
China has essentially become the lone buyer of Iranian barrels. What the sanctions have done is they have forced Iranian barrels into a particular set of Chinese refiners. These small independent refiners are known as teapot refiners that are disconnected from global financial markets, that basically are much more challenging to actually sanction.
So if Iran is not the global supplier it once was, why were oil prices so spooked by the possibility of U.S. military intervention in the country? One issue driving the fear trade is Iran's proximity to a major shipping route, that's the Strait of Hormuz. It is a choke point for oil tankers, with about 20% of the world's oil supply running through the very narrow waterway.
We have seen Iran and Iranian-backed groups before target tankers and targeted critical infrastructure in the Gulf. If you look at 2019, you did have a series of Iranian-backed attacks on tankers in the Straits of Hormuz off of UAE. You had critical pipelines targeted by drones, like the East-West pipeline, which would be the way Saudi would try to divert crude away from the Straits of Hormuz.
Another risk is Iran's proximity to Saudi Arabia, which is one of the world's largest oil producers, and it also has a lot of oil reserves, second only to Venezuela.
When you talk about U.S. producers, when you talk about some of these other major non-OPEC producers like Canada and Guyana and Brazil, they don't sit on spare barrels. They bring their barrels to the market. The only countries that sit on spare barrels are OPEC countries. And again, within that OPEC grouping, the only one right now with significant spare capacity is Saudi Arabia. So if we were to get a confrontation between the US and Iran that led to the loss of Iranian oil exports, there just isn't a lot left in the OPEC tank to cover that.
So far, Iranian oil supply has not been disrupted, and President Trump has pulled back on threats of military intervention. But it remains a very fluid situation, and the White House did announce the possibility of 25% tariffs on Iran's trading partners.
The question is, as President Trump unveils more sanctions on Iran, have we gotten to the point of diminishing returns? Can you really squeeze Iran much more given where their barrels are going? And so the question is, has sanctions now lost its ability to kind of move the needle when it comes to Iranian policy?
The president said on Truth Social, quote, "Iranian patriots keep protesting and that help is on the way."
Watching Iran. You know, we have a lot of ships going that direction just in case. We have a big flotilla going in that direction, and we'll see what happens.
Now, it remains unclear what exactly that help looks like, but President Trump says intervention in Iran would be justified given the human rights violations taking place.
They were going to hang 837 people on Thursday, and I told them, you can't do that. If you do that, it's going to be bad.
Look at Venezuela. We had heard as there was a military buildup that this was about narco trafficking and dealing with migration issues. And then the oil story became the sort of paramount justification for the action. I think when it comes to Iran, we have not yet pivoted to saying this is about oil. This is still about publicly the protests in Iran, about the missile program, Iran's nuclear activities, their behavior in the region.
Now, analysts say the global oil market is well supplied for the time being, but whether it's Iran, Venezuela, or Russia, there are a lot of geopolitical factors that are influencing and shaping global oil flows. And volatility in the oil market, whether it's due to fear or actual supply disruptions, does trickle down to the U.S. consumer. That could show up in higher prices at the pump, higher costs for energy or travel, or even higher transport and shipping costs that wind up inflating the price of goods.